What if I told you the silver market didn't break? It was locked. China didn't suspend silver trading because silver is weak. They suspended it because something snapped behind the scenes, and the system couldn't handle the pressure. Today, analysts are screaming, silver to $50. But the people with real money, they're doing the exact opposite. Let's break this down into the key truths the headlines won't touch. This was not a routine pause. This was not a technical glitch. This was not regulators being cautious. What happened in China was a hard stop, a full-force intervention after more than 25 violent trading halts in the country's largest silver-linked fund. In market history, halts don't stack up like that unless something is structurally wrong. Volatility alone does not force authorities to shut the doors. Volatility is normal. What terrifies regulators is loss of control. When price moves faster than risk models, when liquidity vanishes mid-session, when sellers disappear and bids become desperate. At that point, markets stop being markets. They become threats. And when that happens, the only remaining tool is suspension. Before we continue, if you're getting value from this video, make sure to hit the subscribe button and turn on notifications so you don't miss upcoming updates. And drop a comment below. What time is it where you are right now, and where are you watching from? I love seeing how global this community is. Leave your location and local time, and I'll catch you in the next one. Think about what that really means. Every halt was a warning flare. Each one told regulators that price discovery was becoming dangerous, not for investors, but for the system itself. After 25 attempts to calm the market failed, the message was clear. Letting trading continue would expose something they could no longer hide. When authorities freeze a market, they are not protecting you from losses. They are protecting the architecture, the plumbing, the leverage chains, the promises stacked on top of promises. This is the moment when paper contracts threaten to collide with physical reality, and reality is winning. You don't lock the doors because demand is weak. You lock them when demand becomes uncontainable. Here's the emotional truth most headlines avoid. Suspensions are admissions of fear. They are silent confessions that supply is tighter than expected, that risk is mispriced, and that continuation would create a feedback loop too violent to manage. When a market is healthy, regulators let it trade, up or down. When a market is fragile, they intervene softly. But when a market is fracturing, they pull the plug. This wasn't about silver falling. This was about silver refusing to behave the way the paper system demanded. Too many buyers, too little metal, too much leverage resting on the assumption that nobody would ask for delivery all at once. Ask yourself this: if silver were truly weak, if confidence were collapsing, why not let it fall? Why not allow price to flush out excess? Because a falling paper price doesn't solve a physical shortage. It exposes it. Lower prices increase demand. Lower prices drain inventories faster. Lower prices invite arbitrage that empties vaults. That is the nightmare scenario. And that is exactly why the doors were locked. The suspension wasn't a signal of collapse. It was a signal of stress beneath the surface, stress so intense that transparency itself became a liability. This is how systemic events begin. Not with explosions, but with silence. A quiet notice. A temporary suspension. A promise to reopen once conditions stabilize. But markets don't stabilize when fundamentals are broken. They only pause while pressure builds. And pressure, once trapped, doesn't disappear. It transfers, it migrates, it erupts somewhere else. China's move was not an isolated decision. It was a tell. A flashing red light that the silver market is no longer just a price chart. It's a battlefield between paper control and physical demand. And when authorities choose to freeze the battlefield, it means the next move, whenever it comes, will be far more violent than the last. This is the moment every seasoned market professional watches for. The moment when arbitrage breaks. Not bends. Breaks. Because arbitrage is the invisible glue that holds global markets together. It's the mechanism that says 1 ounce of silver, anywhere on Earth, should trade at roughly the same value. When that glue fails, you are no longer looking at volatility. You are looking at systemic deception being exposed. Today, silver is trading at 2 radically different prices depending on where you stand. On Western paper exchanges, price is weak, soft, controlled. In Asian physical markets, silver is tight, bid aggressively, and often unavailable, without premiums. That divergence is not noise. It is a scream. Here's why this matters. Arbitrage exists because traders exploit price differences until they disappear. If silver is cheap in one market and expensive in another, capital should flow, metal should move, and prices should converge. But that is not happening, because the metal isn't moving. Paper contracts can trade endlessly, but physical silver has weight, logistics, and scarcity. When arbitrage fails, it tells us something terrifyingly simple. The paper price can no longer force physical compliance. The system assumes infinite liquidity. Reality says otherwise. And when reality refuses to play along, markets fracture along geographic and structural fault lines. This is where the illusion collapses. Western exchanges, dominated by futures and derivatives, set a global price based on leverage, not metal. 1 ounce of silver can be sold, rehypothecated, and promised dozens of times over without ever leaving a vault, if it even exists. Meanwhile, in Asia, buyers demand delivery, not exposure. They don't want settlement in cash, they want bars, coins, inventory. That difference in mindset is why prices are diverging. One market trades confidence, the other trades consequences, and consequences are suddenly far more expensive. Let's be blunt. Two prices mean one is fake. Either silver is abundant and cheap everywhere, or it isn't. Markets cannot coexist indefinitely with a lie at the center. The reason arbitrage hasn't closed the gap is because doing so would require draining already thin inventories from exchanges like COMEX and shipping metal east at a scale the system cannot survive. That would expose how little silver is actually available for delivery versus how much has been sold on paper. That exposure is not allowed. So instead, the system tolerates a split reality, hoping retail investors stay focused on screens instead of supply chains. Emotionally, this is where panic should begin. Not among buyers, but among anyone still trusting headline prices. Two prices tell you trust is gone. Two prices tell you liquidity is selective. Two prices tell you that when stress increases, access, not price, will determine outcomes. In every historical monetary event, this is the stage where paper holders feel calm right up until they aren't allowed to convert. The price they believed in no longer applies, rules change, settlement terms shift, and suddenly market price becomes a suggestion, not a guarantee. This broken arbitrage is not a temporary anomaly. It is a signal flare. It tells us silver has crossed from a speculative asset into a strategic one. It tells us the physical market is voting with capital while the paper market is voting with narratives. And it tells us that when these two worlds finally collide, the adjustment will not be gentle. Prices don't reconcile quietly after trust breaks. They reprice violently. Until then, the most dangerous position isn't being early. It's believing that one price still rules them all, when the market has already moved on. While Western headlines chant the same hypnotic phrase, silver is crashing, something far more important is happening quietly, relentlessly, and without press releases. Smart money is buying. Not dipping a toe, not speculating, buying with urgency, buying with intent, buying as if time itself has become a risk. In Asia, the reaction to falling paper prices has not been fear, it has been aggression. Dealers are cleaned out, premiums refuse to fall, inventory vanishes the moment it appears. This is not retail hysteria. This is what real panic buying looks like, when the panic is not about losing money, but about not getting metal at all. Here's the psychological misdirection most investors miss. Media teaches you that panic buying happens at the top. That's false. True panic buying happens when price falls, but availability tightens. That's the tell. When price says cheap, but supply says gone, experienced capital moves instantly. Smart money understands that price is the least important variable during systemic stress. Access is everything. Ownership is everything. Control is everything. In Asia, investors are not reacting to charts. They are reacting to signals, frozen markets, broken arbitrage, disappearing inventory, and governments quietly preparing for instability. Emotionally, this is where the narrative snaps in half. Western audiences are trained to believe that falling prices mean danger. Asian capital has lived through enough currency crises to know better. They understand that manipulated declines are often invitations, not warnings. When silver is smashed on paper, while physical demand accelerates, it is not a bearish signal. It is a clearance sale created by leverage, not fundamentals. And those who have seen this movie before don't wait for confirmation. They move, while others are still arguing on social media. This buying is not driven by greed. It is driven by memory. Memory of capital controls, memory of frozen bank accounts, memory of inflation that arrives temporarily and never leaves. In that context, silver is not an investment. It is a lifeboat, a neutral asset, no counterparty, no promise, no dependency on a functioning system. When institutions and high net worth buyers accumulate silver during drawdowns, they are not betting on price. They are hedging against trust failure. And trust right now is eroding faster than at any point in decades. What makes this moment especially dangerous for the unprepared is the contrast. Media fear creates emotional paralysis among retail investors, while professional capital exploits that paralysis to accumulate quietly. This is how wealth transfers happen, not at peaks, but during confusion. The louder the crash narrative becomes, the more aggressive the accumulation underneath. That divergence is intentional. Fear is the lubricant that allows metal to move from weak hands to strong hands without pushing price higher too soon. Listen closely to behavior, not commentary. If silver were truly unwanted, dealers would be begging for buyers. Premiums would collapse. Inventory would stack up. Instead, the opposite is happening. Buyers are front-running scarcity. They are paying up for immediacy. They are accepting delays because they believe tomorrow's access will be worse than today's price. That belief does not come from YouTube thumbnails or analyst targets. It comes from flow data, from shipping delays, from vault withdrawals, from signals invisible to casual observers. This is the most uncomfortable truth of all. By the time the narrative flips from silver is crashing to silver is scarce, the buying opportunity is already gone. Panic buying never announces itself as smart. It looks reckless until it looks inevitable. And right now, the people with the most experience navigating broken systems are acting with one unified instinct: get the metal first, ask questions later. This is where the story stops being theoretical and becomes mathematical. The silver market is not facing a future shortage. It is facing a present depletion. Inventories are not tight. They are vanishing. And nowhere is this more dangerous than inside the system meant to guarantee supply. The exchange vaults. What most investors don't understand is that silver doesn't need to run out completely to trigger chaos. It only needs to fall below the level of confidence. And that line has already been crossed. When inventories decline week after week, not because of price spikes but because of physical withdrawal, it tells you demand is no longer speculative. It is urgent. Here's the emotional shock most people aren't ready for. The silver market is small. Shockingly small. Tiny compared to global capital flows. It does not take a wave of buyers to drain supply. Only a shift in behavior. When a handful of large players stop rolling paper contracts and start asking for delivery, the math breaks instantly. Registered inventory, the metal actually available to meet claims, is the thinnest layer in the entire structure. Once that layer erodes, the rest of the market becomes a confidence game. And confidence, once shaken, does not return quietly. At the same time this physical drain is accelerating, a second force is colliding with it: de-dollarization. This is not a political slogan. It is a capital migration. Nations, institutions, and sovereign funds are quietly reducing exposure to dollar-based promises and increasing exposure to real assets. Not because they hate the dollar, but because they no longer trust any system built entirely on debt and leverage. When currencies become weapons, neutrality becomes priceless. Silver and gold are neutral. They do not default. They do not sanction. They do not print. This is where pressure multiplies. As confidence in fiat systems erodes, even slightly, demand for hard assets rises non-linearly. A small loss of trust creates a massive shift in allocation. That shift doesn't show up immediately in price. It shows up in availability. Bars get harder to source. Delivery times stretch. Premiums refuse to collapse even when paper prices fall. This is the telltale signature of a supply squeeze forming beneath a controlled price surface. Emotionally, this is the most dangerous phase of any market cycle. Everything looks calm on the screen while stress builds in the plumbing. Analysts debate targets, commentators argue sentiment, but physical flows don't care about opinions, they care about risk. And right now, risk is telling capital the same thing it has whispered before every major monetary reset. Promises are fragile, metal is final. When enough participants internalize that truth, supply doesn't tighten, it disappears. The critical mistake most investors make is assuming exchanges exist to protect them. Exchanges exist to facilitate liquidity until liquidity threatens the system. When inventories fall too low, rules change. Cash settlement replaces delivery. Position limits appear overnight. Force majeure language suddenly matters. The price you thought you owned becomes irrelevant if you cannot convert it into metal. That's why the inventory drain matters more than any chart pattern. It is the countdown clock no one wants you to watch. This is not about silver being rare in nature. It is about silver being rare at the margin, where delivery obligations meet reality. And margins are where systems fail. When de-dollarization accelerates and physical demand collides with shrinking inventories, the market doesn't adjust politely. It snaps, quietly at first, then all at once. Those who understand this are not waiting for confirmation. They are positioning ahead of the moment when supply stops being a statistic and starts being a weapon. This is where the psychological operation becomes obvious, if you know where to look. On one side, you have screaming headlines, analyst notes, and neatly packaged forecasts predicting silver to $50 as if collapse is inevitable. On the other side, you have institutions accumulating quietly, methodically, without emotion. This contradiction is not accidental. It is a trap, and it has worked flawlessly for decades. Media exists to manage expectations, not to protect capital. When fear is profitable, fear is manufactured. And right now, fear is being sold aggressively to shake out weak hands before the next structural move. Let's be clear. Analysts do not move markets. Capital does. Forecasts are cheap. Positioning is expensive. When you see bearish projections dominating the narrative while vault activity increases, you are witnessing deliberate misdirection. Institutions do not announce accumulation. They camouflage it. They need liquidity. They need sellers. And the easiest way to create sellers is to convince them that danger is imminent. That is why bearish silver projections are being amplified across financial media outlets like Bloomberg, while physical flows tell a completely different story. Emotionally, this is uncomfortable because it forces you to confront a harsh truth. Headlines are not written for you. They are written for positioning. When silver is described as weak, outdated, or headed for collapse, it creates hesitation. Hesitation creates supply. Supply allows large players to build exposure without driving prices higher too soon. This is not conspiracy. It is standard operating procedure. The market rewards patience, not honesty, and institutions understand this better than anyone. Now look at behavior. While bearish narratives circulate, asset managers, banks, and funds associated with names like BlackRock continue increasing exposure to hard assets across portfolios. They are not chasing upside. They are hedging systemic risk. They understand something retail investors are taught to ignore. Price volatility is noise, counterparty risk is signal. When systems wobble, institutions don't flee to cash. They flee to assets that cannot default. This is why the $50 silver narrative is so effective. It sounds catastrophic, it feels authoritative, and it arrives at exactly the moment when accumulation is easiest. Most people assume institutions react to news. In reality, news reacts to institutions. By the time headlines turn bullish, the metal is already spoken for. The vaults are full, the supply is gone, and the public is left chasing a repriced market they were emotionally bullied out of owning. The Bloomberg trap works because it exploits fear of being wrong, but markets don't punish caution, they punish misplaced trust. When commentary and behavior diverge this sharply, the only rational response is to follow behavior, because narratives change overnight. Positioning does not. This is the moment where investing stops being about returns and starts being about resilience. When banking systems fracture, markets don't crash politely, they malfunction. Liquidity vanishes when you need it most. Correlations go to 1. Assets you thought were diversified fail simultaneously because they are all tied to the same promise, that the system will keep working tomorrow the way it worked yesterday. History shows it never does. And when inflation returns, not as a headline number, but as lived experience, cash becomes a melting asset, not a refuge. Portfolio protection in this environment is not about clever trades. It's about counterparty risk elimination. Who owes you? Who holds your asset? Who decides whether you can access it in a crisis? These questions matter more than upside projections. In systemic stress, ownership beats exposure. Control beats yield. Simplicity beats sophistication. The safest portfolios are not the most complex. They are the most honest. Assets that require trust fail when trust evaporates. Assets that stand alone endure. Emotionally, this is hard because it forces a mindset shift. Investors are trained to optimize, maximize returns, minimize volatility, rebalance quarterly. But during regime changes, optimization is a liability. Survival assets look boring right up until they become essential. Silver fits this profile perfectly. It is small enough to move violently when capital shifts, liquid enough to convert when needed, and tangible enough to exist outside digital permission structures. It does not rely on a functioning banking system to retain value. That alone makes it strategic. When markets are rigged through leverage, suppression, or narrative control, traditional risk models fail. You cannot hedge a rule change with spreadsheets. You hedge it with optionality. Silver provides that optionality. It gives you exposure to monetary stress without dependence on solvency. It gives you portability when capital controls appear. It gives you insurance when inflation erodes purchasing power faster than wages can adjust. This is not theory. This is what capital does when it expects turbulence. The biggest mistake investors make during crises is waiting for confirmation. Confirmation arrives after repricing. By the time banks wobble publicly, portfolios are already damaged. Protection must be built before the fracture becomes visible. That doesn't mean betting everything on one outcome. It means acknowledging uncertainty and owning assets that benefit from disorder rather than order. Silver thrives in that middle space, when confidence weakens, but before panic becomes universal. In the end, portfolio protection is about dignity, the dignity of access, the dignity of choice, the dignity of not being forced to sell at the worst possible moment. Markets will always promise stability right up until they don't. The only question that matters is whether your portfolio is built for a story or for reality.